Let's start with the JPMorgan. I think they're the biggest by market cap in the US, so that would be a good place to start. They reported on Thursday. I think, was it pre-market, Steve, or was it after-market? Pre-market.
I think it's pre.
So they reported revenue of $31.63 billion. That was a miss on $31.95 billion. Earnings came in at $276, and that was a miss as well. They were looking for $288. That's actually minus 28% year over year. 428 million in reserves added versus 3 billion what they released last year. They've actually suspended the buybacks as well, so the market didn't like this very much. Shares were down pretty sharpish. They've had a little recovery today that was last time I looked, but JPMorgan looks like decent value. One of the things I picked out the analyst call, which was quite interesting, was Mike Mayer. He was decided he was going to take Jamie Dimon to town. He said, and I quote, "Hi, good morning. Could you help me reconcile your words with your actions after Investor Day, Jamie? We said a hurricane is on the horizon, but today you're holding firm with your 77 billion expense guide for 2022. I mean, it's like you're acting like there are sunny skies ahead. You're out buying kayak, surfboards, wave runners just before the storm. So is it tough times or not?" So Jamie Dimon, obviously being ever the artful dodger, responded and said, I quote, "Consumers are in good shape. Jobs are plentiful. Consumers spending 10% year on year. Almost 30% more than pre-COVID. Businesses, you talk to them, they are in good shape. They are doing fine. We've never seen business credit be better ever like this in our lifetimes. And that's the current environment." Now, this sounds like the old meme, you know, when Britain ever has a little bit of wind and somebody just posts the deck chair on the floor. Maybe that is the level of hurricane that Jamie Dimon's talking about. But their streets are apart. Do you guys have any thoughts on that?
Yeah, you've hit the nail on the head with this one for me, and it's the reason why I am buying. I don't know what the book value is right now. I think it's still over 1. I think Wells Fargo is the only one that's under 1 at the minute. But the reason why it's gone up today is simply because he came out and he said, in fact, going through a storm gives us opportunities too. So I always remind myself that the economy will be a lot bigger in 10 years. And that's an interview that he's come out with today, actually. So, like you say, there's a big hurricane coming. And what I was reading, and I was big on the jobs report, I read all this as well. And I thought they were doing very well. And I also thought that they were putting more reserves away than they should. I thought, and stopping the buybacks, that was the problem, right? The buybacks was the big problem that sent the price down. It's a bit of a pain, but I think this is good. I had the opposite idea to the market here, where I thought actually these results are suggesting that it's okay. It's that this isn't like great financial crash 2.0. The banks are in brilliant shape. I think we're going through a dip, and I hate it. I hate myself at the moment, but I actually have the opinion that this isn't going to be a massive crash, and I don't think there's more than 20% drop from here. And that's a prediction, but it's actually filled me with a bit of optimism, and that's what's been important for me. Is I felt very optimistic after JPMorgan. I'm still cautious with the rest of the earnings coming out because that's going to be hell. But yeah, it's been an odd couple of days.
Yeah, it has. I saw that JP Morgan's share price was now about where it was in the 2020 COVID dip thing, where I think I actually bought it back then and subsequently let it go a little bit, which I suppose if you're interested in kind of playing the ups and downs of the stock market has worked out okay, right? Because it's now lower than it was where I sold it. But a friend of the show, the Boss Hog, put his finger on something that I kind of have been looking at over the last few quarters here. So JP Morgan's earnings, and this is a theme across all the major banks, by the way, but just pointing out, these ones are down 28% year over year. And the main reason for that is they've had to put aside 428 million in reserves, or have to, or chosen to, whatever it is. Jamie Dimon, by the way, is livid about that stress test, from what I understand of it. He said a lot of things that were not at all complimentary about the way it's done, and he thinks it's fairly capricious and not transparent, and so on and so forth. But comparing this to the same quarter last year when they had a 3 billion release, which gave them a lot more kind of earnings power, I mean, Boswell wanted to point out, at least as I understood his point, that the market does tend to overreact to these things, or might well have a tendency to overreact to these things. Bank shares went mad last year because they were all releasing loan reserves, basically. It looked like the kind of stuff they put aside during the real problems of COVID stuff, when everything looked like the world was ending. That suddenly came back into play, and everyone thought, oh, great, banks are all brilliant, now buy them and buy them and buy them and buy them. And now they have to put them aside again. It's sell them and sell them and sell them. It does make a difference to the fundamentals. It's not money you can loan out. And actually, with interest rates higher, the interest rate you might get at, 4% on 428 is a lot more than the interest you would get on 2% at 428 or something like that. So I take the point that there is something to react to with this. But I wonder whether they sometimes overreact to these things, especially with interest rates higher. That should be helping banks like JPMorgan.
And the reason it came
in
under estimates, the main reason, was investment banking. So there's less fees going into these banks. BlackRock was a really big one that didn't do very well, straight on the earnings on Thursday as well, seeing less than, say, normal, but we're talking about 2020 and 2021 here. They're seeing a receding in investment transactions, i.e. fees. So all of those fees that people pay to Vanguard and Hargreaves Lansdown and to be fair, Trading 212 as well, those are not they're not there anymore. So this is something that I've always worried about as well, particularly with some of the brokers we use. And the big boom in brokers, we're starting to see it crypto with Celsius and BlockFi completely collapsing. They're collapsing because people don't want to invest at the moment. And I don't like that mood that's out there. And we're obviously starting to see that in these banks and in BlackRock as well. Although they class BlackRock as a bank these days. Still, lots of reserves. I thought the reserves were really good with JPMorgan. I like Jamie Dimon being cautious, but I like the optimistic tone at the same time. And I like that it's just a very cautious way of moving. I don't like that the market doesn't think it's very good, which was a problem. That was the only thing.
I don't really have a problem with banks putting reserves away either, to be honest. I think I would much sooner that than have some massive financial crisis. I don't really see Jamie Dimon's argument on this, but he's been a bit flip-floppy recently.
I think he likes attacking, doesn't he?
Well,
he likes just jabbing.
Maybe he'll like the stress tests tomorrow when we ask him a question about it, Sam.